We bought this property at 30% below market. Here's how. What everyone says is impossible, isn't. At Venus Venture, we don't chase overpriced deals, we create value from the very beginning by buying right. And nothing proves this better than our recent acquisition, a multi-unit property purchased at 30% below market value. That kind of discount raises eyebrows. It's rare, yes, but not impossible. In fact, this deal showcases the exact strategy we use to find undervalued assets that others overlook. Here's the full breakdown of how we did it, and how we plan to turn this into one of our highest performing assets yet. The property. On paper, a problem. The asset was a 24-unit multifamily property in a growing secondary market. It had been sitting on the market for months, with very little buyer interest. Here's why. Only 60% occupancy, deferred maintenance across all units. Outdated plumbing, roofing, and electrical, mom-and-pop owner with no digital rent records. Broker described it as a management headache. But where others saw a mess, we saw margin. Step 1. Direct-to-owner negotiation. This deal never hit a competitive bidding war because we approached the owner directly after a failed listing expired. We built a relationship over a series of conversations and learned two key things. The owner was tired and managing multiple properties solo. They were more interested in a clean exit than maximum price. We offered a quick, as-is close with no financing contingencies, and they agreed to a 30% discount off the appraised value in exchange for certainty. Step 2. No bank equals no delays. Traditional financing would have killed this deal. Lenders didn't want to touch it due to poor financials and low occupancy. Instead, we used hard money financing for fast approval. Internal capital from our fund to cover rehab. No appraisal required, no full underwriting delays. We closed in 15 days, a key reason the seller accepted our price. Step 3. Hidden value others missed. Even at first glance, we saw the upside, but we underwrote deeper. Average rents were 25% below market. The area had a 4% vacancy rate and strong demand. The roof and plumbing issues looked worse than they were. Local incentives available for energy-efficient upgrades. Our model showed that within 12 months we could increase NOI by 60% through light renovation, lease-ups, and improved management. Step 4. Our plan to create value. We didn't just buy cheap, we bought smart. Our game plan. $400,000 rehab budget focused on curb appeal and unit interiors. Use our preferred property management team to stabilize quickly. Target full occupancy in 8 months. Plan for refinance in 12-15 months, pulling out 80 to 90% of our capital. Even with conservative projections, we're expecting 20-23% IRR and over 2.5x equity multiple in 5 years. Why this matters. In a world where many investors overpay for turnkey assets,